Welcome back to the Longacres Finance channel, where the focus is on dividend growth investing. To keep with the spirit of talking about the Dividend Aristocrats, it's time to take a look at which aristocrats look the best for the month of November, using my 3 simple strategies to beat NOBL. September was a pretty rough month for the stock market, and the aristocrats were no exception. NOBL, the Dividend Aristocrat ETF, fell 9.15% during the month, which turned out to be the second worst month for the fund since its launch in November of 2013. October is looking much brighter thus far, as the fund is up 6.04% through Monday the 24th. However, even with this little bounce in October, NOBL is still down 12.49% this year, and on pace to have its worst annual return. My 3 strategies underperformed NOBL in September and suffered larger losses, but all 3 continue to remain ahead of NOBL and SPY since inception. The alpha over NOBL ranges from 3.52% to 6.17%. And the alpha over SPY ranges from 12.5% to 15.14%. These are pretty large cushions that should keep these strategies ahead of both benchmarks for at least a while. My 3 strategies are all very simple and based on principles that fundamentally make sense. So let's talk about each strategy, how it's performing, and what selections it made for the upcoming month. First up, we have the most undervalued strategy. And like the name suggests, this strategy seeks out the 10 most undervalued aristocrats right now, with the aim that we can buy shares at discounted prices today and benefit when the stock recovers in the future. So it is a long-term strategy because it requires us to be patient and wait for valuations to revert back to the mean. In September, the buy and hold portfolio built on this strategy fell by 11.39%, which is more than 2% worse than NOBL. October is looking a little better as the portfolio is up 5.68%, which is still worse than NOBL but not by a wide margin. These strategies don't beat NOBL every month, and that is not the objective. The objective is to generate long-term outperformance, and thus far that has been working out quite nicely. Year-to-date, this portfolio is down 8.85%, compared to a loss of 12.49% for NOBL. And since inception, which was August of 2021, the portfolio is beating NOBL by 6.17%. Thus far, the most undervalued strategy is the best performing strategy. It didn't start out this way, and things may flip in the future. The strategy is very simple. Each month I use dividend yield theory to determine which dividend aristocrats are the most undervalued. If you don't know what dividend yield theory is, it works on a basic principle that dividend stocks with consistent histories revert back to their trailing dividend yields over longer periods of time. Hence, when we invest in stocks with dividend yields that are above their trailing averages and wait, we should benefit from the reversion back to the mean. Let's have a look at who the top 10 most undervalued dividend aristocrats are right now. Going into the portfolio for the month of November, we have Ecolab that looks about 25% undervalued, Lowe's that also looks about 25% undervalued, Medtronic that looks about 32% undervalued, McCormick that looks about 24% undervalued, 3M Company that looks about 30% undervalued, Sherwin-Williams that looks about 25% undervalued, Stanley Black & Decker that looks about 51% undervalued, T. Rowe Price Group that looks about 28% undervalued, VF Corporation that looks about 59% undervalued, and Walgreens that looks about 28% undervalued. The average dividend yield for these 10 aristocrats is a decent 3.57%, with VF Corporation offering the most attractive yield of nearly 7%. The stock has really tumbled during the last few weeks and pushed the dividend yield significantly higher. 3M Company and Walgreens also offer dividend yields in excess of 5%, with Stanley Black & Decker and T. Rowe offering dividend yields above 4%. In terms of forward-looking returns, all but 2 of these aristocrats look attractive. McCormick and T. Rowe Price Group currently don't have an annual rate of return estimate above 12%. This rate of return is based on future earnings growth and current valuation. Albeit, in T. Rowe's defense, there is no earnings growth forecast available right now from the source I use. The second simple strategy I have been tracking is the top 10 aristocrats based on expected rate of return. Here I simply select the 10 aristocrats that have the highest return estimates. The buy and hold portfolio for this strategy also performed quite poorly in September, losing 11.37% and grossly underperforming NOBL and SPY. October is looking much better as the buy and hold portfolio for this strategy is up 9.02%, which is almost 3% better than NOBL and SPY. The strong return in October is driven by Chevron, Nucor, and Exxon that are all up more than 20% this month. Caterpillar, Cisco, and AT&T, that are also part of this portfolio, are also doing very well, with each being up about 15%. Year-to-date, the portfolio is down 11.92%, which is 0.57% better than NOBL. Since inception, the portfolio is beating NOBL by 5.08%, and SPY by 14.06%. In comparison to the most undervalued strategy, The fastest expected growth strategy is trailing by 1.08%. Not a wide margin, and one that can be quickly erased. I expect that this strategy will perform the best in the bull market, as it is focused towards growth rather than value. My expected rates of return that are used to select the top 10 aristocrats each month are computed as follows. I take the 5-year forward earnings growth estimate with a margin of safety, and I add to this the current dividend yield and a return to fair value over a 5-year period. The top 10 selections for November all have a rate of return estimate greater than 18% per year, and the chosen aristocrats for next month are Albemarle, Clorox, Medtronic, Nucor, Realty Income, Stanley Black & Decker, Cisco, Target, VF Corporation, and West Pharma. The average dividend yield for these 10 aristocrats is 2.99%, so about a 0.5% lower than the most undervalued strategy. The dividend yields also range pretty wildly, as West Pharma currently has a 0.29% yield, while VF Corporation yields nearly 7%. Only 6 of these 10 aristocrats look undervalued based on dividend yield theory. The ones that aren't are Albemarle that looks 142% overvalued, Nucor that looks 72% overvalued, Cisco that looks about 1% overvalued, and West Pharma that looks about 7% overvalued. But each of these aristocrats is poised for above average earnings growth in the near future, and because of this, they earn a spot on the top 10 list this month. And the final strategy is the blended strategy, that is meant to be a combination of the first two strategies. Here I focus on the fastest expected rates of return, but only for aristocrats that are undervalued today. So this portfolio will skip over the 4 overvalued aristocrats I just mentioned from the fastest expected growth strategy, and replace them with the next 4 highest aristocrats that also look undervalued today. The buy and hold portfolio for this strategy was down 10.88% in September, so while it performed better than the prior 2 strategies, it still lost to NOBL and SPY. October isn't looking much better, as the blended strategy is up only 5.59%, which is the lowest return amongst the 3 strategies. Year to date, this portfolio is down 11.38%, which is better than both NOBL and SPY. Since inception, this portfolio remains 3.52% ahead of NOBL, and 12.5% ahead of SPY. The 10 chosen aristocrats for the month of November by this strategy are Abbott Labs that looks about 22% undervalued, Clorox that looks about 23% undervalued, Ecolab that looks about 25% undervalued, Lowe's that looks about 25% undervalued, Medtronic that looks about 32% undervalued, Realty Income that looks about 15% undervalued, Sherwin-Williams that looks about 25% undervalued, Stanley Black & Decker that looks about 51% undervalued, Target that looks about 18% undervalued, and VF Corporation that looks about 59% undervalued. The average dividend yield for these 10 aristocrats is 3.17%, which is higher than the fastest expected growth strategy, but not the most undervalued strategy. The 10 selections for November have an expected rate of return of at least 14% per year, and most importantly, they all appear to be undervalued today. Originally, my hypothesis was that this strategy would end up somewhere in between the other 2 strategies. However, as of now it has the lowest rate of return, albeit still better than NOBL. It's definitely been an interesting period of time to be tracking these strategies. The latter part of 2021 was a period of consistent strong returns, while in 2022 everything seems to be falling apart. The one benefit of a long-term buy and hold strategy is that during periods of falling share prices, we can dollar cost average down into some solid dividend stocks. I'm thinking that starting next year, I will only make these selections once for the buy and hold portfolios. Whichever aristocrats present the best opportunity near the end of this year will be chosen for all of 2023. I'll still continue tracking which aristocrats are the most undervalued and which ones have the highest expected rates of return, but I want to have less movement in the buy and hold portfolios. I've only been tracking these strategies for about 15 months now, and the buy and hold portfolios all have around 30 unique aristocrats in them. Part of this is due to the volatility in the market this year. I honestly don't think that the alpha these portfolios have been able to generate will be impacted by this shift. I hope you enjoyed the content. If you did, I would appreciate if you gave this video a like and subscribe to the channel to help me grow this dividend community. Thank you for watching and see you next time.